Question 1. Fundamentals of reinsurance. Which of the following best explains the primary purpose of reinsurance for a ceding insurer? A. To increase the number of policies an insurer can issue without regulatory oversight. B. To share risks with another entity, reducing financial exposure in case of significant claims. C. To eliminate the need for maintaining reserves for policyholder obligations. D. To provide direct coverage to policyholders in the event of the primary insurer's default. Answer. B. To share risks with another entity, reducing financial exposure in case of significant claims. Explanation. Reinsurance is a mechanism where the primary insurer transfers part of its risks to a reinsurer, thereby mitigating its exposure to large financial losses. This allows insurers to underwrite more policies while maintaining solvency and complying with regulatory requirements. Option is incorrect because reinsurance does not bypass regulatory oversight. It complements compliance. Option C is incorrect because insurers must still maintain appropriate reserves as mandated by regulators. Option D is incorrect as reinsurance supports the primary insurer but does not directly interact with policyholders. Relevant rules. South Dakota Insurance Code requires that reinsurance agreements adhere to solvency and risk-sharing standards to protect the financial health of ceding insurers. Question 2. Scenario-based question. Claims management in reinsurance. MS Harper's Insurance Company has ceded portion of its property insurance portfolio to reinsurer under quota share treaty following major wildfire. MS Harper submits claim to her primary insurer. The claim qualifies under the reinsurance agreement, but there is disagreement between the ceding company and the reinsurer regarding the amount recoverable. What best course of action for resolving this dispute? A. The reinsurer should immediately pay the amount demanded by the ceding company to avoid litigation. B. The ceding company should resolve the dispute internally without involving the reinsurer. C. Both parties should refer to the arbitration clause in their reinsurance agreement to settle the disagreement. D. The ceding company should terminate the treaty and pursue legal action against the reinsurer. Answer. C. Both parties should refer to the arbitration clause in their reinsurance agreement to settle the disagreement. Explanation. Reinsurance agreements commonly include arbitration clauses to resolve disputes efficiently and cost-effectively. Arbitration ensures that disputes are handled by experts familiar with reinsurance practices, minimizing the risk of prolonged litigation. Option is incorrect as it ignores the contractual processes and could lead to overpayment. Option B is incorrect because disputes related to recoverables must involve both parties. Option D is incorrect as termination of the treaty is an extreme measure not aligned with standard dispute resolution practices. Relevant rules. South Dakota reinsurance contracts often require arbitration for dispute resolution. This aligns with NAIC model regulations on reinsurance agreements. Question 3. Reinsurance pricing and financials. In a surplus share treaty, the ceding insurer retains $500,000 of liability per policy. A claim of $800,000 is filed under a policy covered by the treaty. If the reinsurer's share of the liability is 60%, how much will the reinsurer be responsible for? A. $180,000. B. $300,000. C. $480,000. D. $500,000. Answer. C. $480,000. Explanation. In a surplus share treaty, the reinsurer assumes liability for claims exceeding the retention limit of the ceding insurer. Here, ceding insurer retains $500,000. Claim amount is $800,000, so the reinsurer covers the excess $800,000. 500th this is annuals $300,000. The reinsurer's share of this $300,000. Excess is $300,000 x 60 pay equals $180,000. Additionally, the reinsurer also covers 60% of the retained liability. 500,000 x 60 pay equals $300,000. Total reinsurer liability 180,000 plus 300 this is annuals $480,000. Option is incorrect as it calculates only portion of the reinsurer's liability. Option B is incorrect as it ignores the shared portion of the ceding company's liability. Option D is incorrect because it reflects the ceding company's retention limit, not the reinsurer's liability. Relevant rules. Reinsurance treaties in South Dakota must specify the sharing of liabilities clearly, adhering to NAIC standards for proportional and non-proportional agreements. Question 4. Regulatory framework for reinsurance in South Dakota. Which of the following is A key requirement for a reinsurer to operate in South Dakota. A. Maintaining a minimum surplus of $10 million and being domiciled in South Dakota. B. Obtaining a certificate of authority from the South Dakota Division of Insurance. C. Submitting quarterly reports only to NAIC, bypassing state regulators. D. Being approved by the National Reinsurance Advisory Council. Answer B. Obtaining a certificate of authority from the South Dakota Division of Insurance. Explanation. To operate legally in South Dakota, a reinsurer must obtain a certificate of authority from the state's Division of Insurance. This ensures compliance with financial and operational standards set by the state. Option is incorrect because domicile within South Dakota is not mandatory. Option C is incorrect as state regulatory reporting is required in addition to NAIC filings. Option D is incorrect because the National Reinsurance Advisory Council does not oversee reinsurer approvals. Relevant rules. South Dakota Insurance Code requires all reinsurers to meet licensing and solvency standards and regularly report to the state's Division of Insurance. Question 5. Risk management and retention. Which factor is most critical in determining the retention limit in a proportional reinsurance agreement? A. The reinsurer's financial strength and ratings. B. The ceding company's overall capital and risk tolerance. C. The policyholder's ability to pay premiums. D. The expected frequency of small claims in the portfolio. Answer B. The ceding company's overall capital and risk tolerance. Explanation. Retention limits are set based on the ceding company's financial capacity to absorb losses and its appetite for risk. This ensures solvency and operational stability. Option is incorrect as it pertains more to the reinsurer's credibility, not retention limits. Option C is irrelevant to retention calculations. Option D is factor in claim patterns but not the primary determinant for retention limits. Relevant rules. NAIC guidelines stress the importance of aligning retention limits with the insurer's capital structure and risk management strategy. Question 6. Scenario-based question, legal and compliance aspects. Mr. Daniels, an underwriter for a ceding insurer, discovers that a reinsurance contract lacks a clear insolvency clause. During a financial review, it's revealed that the reinsurer may face insolvency issues. What should Mr. Daniels do to ensure compliance with South Dakota's legal requirements? Options. A. Cancel the contract immediately to protect the ceding insurer. B. Notify the South Dakota Division of Insurance and seek regulatory guidance. C. File lawsuit against the reinsurer to recover potential future losses. D. Continue the agreement and wait for insolvency proceedings to commence. Answer B. Notify the South Dakota Division of Insurance and seek regulatory guidance. Explanation. South Dakota law requires reinsurance agreements to include an insolvency clause to protect ceding insurers. If a reinsurer shows signs of financial instability, notifying regulators ensures compliance and mitigates risk. Option is incorrect as cancellation without regulatory input could violate contractual obligations. Option C is premature. A legal action might only follow insolvency proceedings. Option D is risky and disregards compliance obligations. Relevant rules. South Dakota Insurance Code mandates that reinsurance contracts have clear provisions to address insolvency risks, and regulatory oversight is critical in such scenarios. Question 7. Reinsurance contract structures in a quota share treaty. How does the reinsurer's liability typically align with premium sharing? A. The reinsurer's liability is always equal to 50% of the premium, regardless of agreement terms. B. The reinsurer's liability and premium share are proportional to the agreed percentage split. C. The reinsurer assumes all liability but receives only a fraction of the premium. D. The reinsurer's liability is inversely proportional to the premium split. Answer B. The reinsurer's liability and premium share are proportional to the agreed percentage split. Explanation. In quota share treaty, both premiums and claims are divided between the ceding insurer and the reinsurer based on the agreed proportional split. Option is incorrect because the percentage split can vary. Option C is incorrect as liability is shared proportionally, not fully shifted. Option D misrepresents the relationship between premiums and liability. Relevant rules. Quota share treaties must explicitly define the proportional sharing of premiums and claims as per NAIC model agreements. Question 8. Reinsurance pricing and financials. A reinsurance company offers an excessive loss treaty with a $1 million attachment point. If a claim of $2.5 million is filed, how much will the reinsurer pay? A $1 million B. $1.5 million. C. $2 million. D. $2.5 million. Answer: B. $1.5 million. Explanation: excessive loss treaties cover losses exceeding the attachment point. The reinsurer is responsible for 2.5 million. 1.0 mil equals 1.5 million. Option is incorrect as it excludes the portion exceeding the attachment point. Option C overestimates the reinsurer's liability. Option D assumes full coverage, disregarding the attachment point. Relevant rules. South Dakota regulations require clear definitions of attachment points and reinsurer obligations in excessive loss agreements. Question 9. Ethics and professional standards in reinsurance. Which practice violates ethical standards in reinsurance? A. Reinsurers performing due diligence on ceding insurers. B. Ceding insurers withholding material information about high-risk policies. C. Sharing actuarial data between reinsurers and ceding companies. D. Negotiating premium rates based on risk analysis. Answer: B. Ceding insurers withholding material information about high-risk policies. Explanation: ethical standards mandate full transparency between ceding insurers and reinsurers. Withholding information undermines trust and leads to unfair risk sharing. Option is an ethical practice ensuring financial stability. Option C facilitates accurate risk assessments. Option D is standard industry practice. Relevant rules. South Dakota adheres to NAIC ethical guidelines emphasizing disclosure and transparency in reinsurance transactions. Question 10. Catastrophe and excessive loss coverage. Which of the following is a common method for reinsurers to manage aggregation, risk and catastrophe coverage? A. Limiting coverage to individual policies only. B. Utilizing catastrophe bonds to transfer risk to the capital markets. C. Capping the number of policies ceded under the treaty. D. Requiring the ceding insurer to handle all claims below $10 million. Answer: B. Utilizing catastrophe bonds to transfer risk to the capital markets. Explanation: catastrophe bonds allow reinsurers to transfer aggregation risks to investors, diversifying financial exposure to large-scale events. Option is incorrect as aggregation risk applies across multiple policies. Option C is uncommon in catastrophe treaties. Option D reflects retention strategies, not aggregation risk management. Relevant rules. South Dakota reinsurance regulations align with global practices, allowing innovative risk transfer methods like catastrophe bonds. Question 11. Risk transfer in reinsurance. In South Dakota, what is the primary test used to determine whether a reinsurance agreement constitutes sufficient risk transfer? Options: A. The agreement must transfer at least 50% of premium risk. B. The agreement must transfer both underwriting and timing risk. C. The agreement must only transfer underwriting risk. D. The agreement must specify a minimum loss ratio threshold. Answer: B. The agreement must transfer both underwriting and timing risk. Explanation: reinsurance agreements must demonstrate sufficient transfer of underwriting risk, loss volatility, and timing risk cash flow uncertainties to be recognized as legitimate under South Dakota regulations. Option is incorrect because there is no fixed percentage for risk transfer. Option C is incomplete as timing risk must also be transferred. Option D is unrelated to the determination of risk transfer. Question 12. Credit for reinsurance. Which of the following conditions must be met for a ceding insurer to receive credit for reinsurance under South Dakota law? A. The reinsurer must be rated at least A. by an approved rating agency. B. The reinsurance contract must include an insolvency clause. C. The reinsurer must be domiciled within the United States. D. The ceding insurer must retain at least 25% of the risk. Answer: B. The reinsurance contract must include an insolvency clause. Explanation: South Dakota law requires an insolvency clause in reinsurance contracts to ensure that the reinsurer continues to pay claims even if the ceding insurer becomes insolvent. Option is incorrect because credit is not solely dependent on rating. Option C is incorrect as foreign reinsurers can qualify if they meet regulatory standards. Option D is not a requirement under South Dakota law. Question 13. Proportional versus non-proportional reinsurance. In non-proportional reinsurance, what is the primary determinant of a reinsurer's liability? A. The ceding insurer's written premium. B. The aggregate claim amount exceeding predefined threshold. C. The proportional split of premiums and losses. D. The total number of policies issued by the ceding insurer. Answer B. The aggregate claim amount exceeding a predefined threshold. Explanation: non-proportional reinsurance, such as excessive loss, triggers the reinsurer's liability only when claims exceed a specified attachment point. Option A applies to proportional treaties. Option C refers to proportional reinsurance. Option D is unrelated to non-proportional contracts. Question 14. Catastrophe risk models. Why are catastrophe risk models critical for reinsurers? A. They help reinsurers determine individual policy premiums. B. They estimate aggregate losses from low-severity events. C. They provide projections for losses from infrequent but severe events. D. They are mandated by South Dakota's Division of Insurance for all contracts. Answer C. They provide projections for losses from infrequent but severe events. Explanation: catastrophe risk models help reinsurers estimate potential losses from rare, high-impact events, enabling better risk management and pricing. Option A is more relevant to primary insurers. Option B applies to frequency risk, not catastrophic events. Option D is incorrect, as such mandates do not exist universally. Question 15. Reinsurance treaties and loss portfolios. Which of the following is the primary purpose of a loss portfolio transfer? A. To transfer underwriting risk for future policies. B. To transfer existing claims liabilities to a reinsurer. C. To increase the ceding insurer's underwriting capacity. D. To enable the reinsurer to terminate treaty prematurely. Answer B. To transfer existing claims liabilities to a reinsurer. Explanation: a loss portfolio transfer allows a ceding insurer to transfer its existing claims liabilities to a reinsurer, often as part of runoff management or restructuring. Option applies to prospective reinsurance. Option C is a broader objective of reinsurance, not specific to loss portfolio transfers. Option D is unrelated to the concept. Question 16. Regulatory reporting. Under South Dakota reinsurance regulations, how often must a reinsurer file financial statements with the Division of Insurance? A. Annually. B. Quarterly. C. Biannually. D. Monthly. Answer A. Annually. Explanation: reinsurers are required to file annual financial statements to demonstrate solvency and compliance with regulatory standards. Option B is incorrect, as quarterly filings are not mandated in all cases. Option C and Option D are not standard requirements. Question 17. Runoff reinsurance agreements. In a runoff reinsurance agreement, what is the primary role of the reinsurer? A. To provide coverage for new policies issued by the ceding insurer. B. To manage and settle the remaining liabilities from expired policies. C. To restructure the ceding insurer's existing capital base. D. To terminate all active reinsurance treaties. Answer B. To manage and settle the remaining liabilities from expired policies. Explanation: runoff agreements focus on managing the liabilities of policies that are no longer active, enabling the ceding insurer to focus on current operations. Question 18. Sidecar arrangements in reinsurance. What is the primary purpose of a sidecar arrangement? A. To enable primary insurers to reduce underwriting costs. B. To allow reinsurers to raise additional capital for specific risks. C. To provide retroactive coverage for claims already incurred. D. To manage small, high-frequency claims more effectively. Answer B. To allow reinsurers to raise additional capital for specific risks. Explanation: sidecar arrangements are used by reinsurers to attract capital from investors for specific portfolios, enabling risk sharing and capital efficiency. Question 19. Commutation agreements. What is the primary objective of a commutation agreement in reinsurance? A. To cancel the reinsurance contract retroactively. B. To terminate a reinsurance contract and settle all outstanding claims obligations. C. To increase the reinsurer's liability under the contract. D. To transfer policies from the ceding insurer to the reinsurer. Answer B. To terminate a reinsurance contract and settle all outstanding claims obligations. Explanation: commutation agreements are used to finalize and close all obligations under a reinsurance contract. Question 20. Reinsurance and risk diversification. Why is diversification critical in a reinsurer's portfolio? A. It eliminates the need for regulatory reporting. B. It minimizes exposure to correlated risks. C. It guarantees profitability in all market conditions. D. It ensures compliance with NAIC solvency standards. Answer: B. It minimizes exposure to correlated risks. Explanation: diversification reduces the reinsurer's vulnerability to losses from correlated risks, such as geographic or event-specific exposures. Question 21. Reinsurance pools. What is the primary function of a reinsurance pool? A. To reduce regulatory scrutiny of individual reinsurers. B. To combine resources from multiple reinsurers to cover large risks. C. To eliminate the need for individual risk assessments. D. To transfer all underwriting responsibilities to the ceding insurer. Answer: B. To combine resources from multiple reinsurers to cover large risks. Explanation: reinsurance pools allow multiple reinsurers to share the financial burden of large, complex risks that are too significant for any one reinsurer to cover alone. Question 22. Trust funds for reinsurance. What is the purpose of a reinsurance trust fund under South Dakota regulations? A. To provide a mechanism for reinsurers to avoid paying claims. B. To secure the ceding insurer's recovery in case of reinsurer insolvency. C. To increase the reinsurer's underwriting capacity. D. To minimize the need for collateral in cross-border treaties. Answer: B. To secure the ceding insurer's recovery in case of reinsurer insolvency. Explanation: reinsurance trust funds are established to protect the ceding insurer by holding assets that can be used to pay claims if the reinsurer defaults. Question 23. Reinsurance collateral requirements. When is a reinsurer required to post collateral for a reinsurance contract? A. When the reinsurer is domiciled outside of the United States. B. When the reinsurer fails to meet a minimum solvency margin. C. When the reinsurer is not licensed or accredited in the ceding insurer's state. D. All of the above. Answer: D. All of the above. Explanation: reinsurers must post collateral if they are not licensed or accredited in the ceding insurer's state, are domiciled internationally, or do not meet solvency requirements. Question 24. Excessive loss reinsurance. In an excessive loss reinsurance treaty, what does the attachment point represent? A. The maximum liability of the ceding insurer. B. The premium threshold at which reinsurance coverage begins. C. The amount of loss the ceding insurer must retain before reinsurance applies. D. The total limit of coverage provided by the reinsurer. Answer: C. The amount of loss the ceding insurer must retain before reinsurance applies. Explanation: the attachment point is the level of loss the ceding insurer must bear before the reinsurer's coverage begins under an excessive loss treaty. Question 25. Pro rata reinsurance. Which of the following best describes a pro rata reinsurance treaty? A. The reinsurer pays only if losses exceed a certain threshold. B. The reinsurer and ceding insurer share premiums and losses proportionally. C. The reinsurer assumes responsibility for specific risks without sharing premiums. D. The reinsurer pays a fixed amount for each claim regardless of size. Answer: B. The reinsurer and ceding insurer share premiums and losses proportionally. Explanation: pro rata treaties involve proportional sharing of premiums, losses, and expenses between the reinsurer and the ceding insurer. Question 26. Stop loss reinsurance. What is the primary goal of stop-loss reinsurance? A. To provide coverage for catastrophic events. B. To cap the total losses of the ceding insurer during a specific period. C. To share the underwriting risk on a proportional basis. D. To replace quota share reinsurance contracts. Answer: B. To cap the total losses of the ceding insurer during a specific period. Explanation: stop-loss reinsurance protects the ceding insurer by limiting their aggregate losses over a defined period, typically an underwriting year. Question 27. Regulatory frameworks for captive reinsurers. Which regulatory requirement is typically waived for captive reinsurers in South Dakota? A. Minimum capital and surplus requirements. B. Annual financial statement filing. C. Rate and form filing requirements. D. Compliance with international solvency standards. Answer: C. Rate and form filing requirements. Explanation: captive reinsurers are often exempt from rate and form filing requirements because they are formed to insure risks of their parent organizations or affiliated companies. Question 20. Retrocession in reinsurance. What is the primary purpose of A retrocession agreement. A. To enable a primary insurer to cede risks to a reinsurer. B. To allow a reinsurer to pass on some of its risk to another reinsurer. C. To transfer the entirety of a reinsurer's obligations to third party. D. To provide reinsurance coverage for catastrophic events only. Answer. B. To allow a reinsurer to pass on some of its risk to another reinsurer. Explanation. Retrocession agreements enable reinsurers to spread their risks by ceding portions of their liabilities to other reinsurers. Question 29. Sliding scale commissions. How does the sliding scale commission in a reinsurance treaty function? A. The ceding insurer pays a fixed commission regardless of performance. B. The commission adjusts based on the treaty's loss ratio. C. The reinsurer pays higher commissions for low premium volumes. D. The ceding insurer receives refund for claims exceeding threshold. Answer. B. The commission adjusts based on the treaty's loss ratio. Explanation. In sliding scale commissions, the reinsurer adjusts the commission paid to the ceding insurer based on the loss ratio, incentivizing better underwriting results. Question 30. Key provisions in reinsurance contracts. Which provision in a reinsurance contract typically specifies the reinsurer's obligations when the ceding insurer becomes insolvent? A. Arbitration clause. B. Insolvency clause. C. Premium adjustment clause. D. Runoff management clause. Answer. B. Insolvency clause. Explanation. The insolvency clause ensures that the reinsurer continues to fulfill its obligations even if the ceding insurer is declared insolvent.